expense ratio is like 32%, compared to like multifamily in Texas, which can get you like 55%, heavily because of taxes and insurance. So I like the low cost of the expenses on these type of facilities. I also like that there's no emotions or no eviction court, or, it's like, hey, you pay your rent or you get locked out of your unit. And people tend to be more motivated to get their expensive stuff out of their unit by the 10th of the month. And so it makes it very easy to manage and operate. And we're looking at scaling that at a much bigger scale.
Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman. Today we're joined with Wayne Courageous. Wayne helps busy professionals build wealth through passive real estate investments. Wayne is the founder of CREI Partners. He manages around $50 million in assets, focusing on multifamily and storage development. Wayne, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Hey, Josh, thanks for having me on. It's great meeting you and excited to hopefully add some value to the listeners. I'm Wayne Courageous. I'm based in Central Texas. Been in commercial real estate about 17 years. Big chunk of that was with my prior W-2 employer, CBRE. I worked with them about 16 years, and I started CREI Partners back in 2019. Left CBRE to go all in on our investments and growing our portfolio back in July 23, and excited to share my journey and again, add value to your listeners.
Got it. Perfect. That's a great track record. Well, you actually growing your track record in the brokerage world. You've seen a lot of transactions take place, a lot of due diligence, a lot of back and forth, investment side, brokerage side, and then owner side. So tell us how that journey began, and then let's just talk about the beginnings of that journey, because I think that's a great way to get started in real estate.
Yeah, so I started real estate back when I was in the Marine Corps. I bought my first single family rental when I was stationed in 29 Palms. I think I was like 19. And, it's really how it started. Even before then, I was in high school and dated somebody whose dad was a successful developer. And so it got me the itch to do real estate. And I haven't ever gone back since. It's been something that I've been really passionate about. But when I joined CBRE, it was right after serving in the Marine Corps, 2003 to 2007. And I was trying to get in actually with Trammell Crow Development. But at that time, CBRE was acquiring or merging, depending on which side of the aisle you're on. They were, becoming one. And at that time, there wasn't a whole lot of opportunities within the firm, one with the market going on in 2007, 2008, but also, this merger. But I actually got into the property management world. So for 16 years, I was heavy on asset management, property management, working life cycles of properties, from acquisitions to, executing the business plan to refinance or selling the asset. That was a big part of what I did every day for clients. And so really 2019. So I started that, with CBRE 2007, June of 2007. And then the end of 2019, I was sort of having this, I don't know if you call it a midlife crisis, because I was still pretty young, but I was like, am I going to continue doing this? Because, I'm making these great clients and people I'm working with very wealthy and they're investors. So I wanted a piece of it, but I knew I wouldn't be able to get that on the track that I was with CBRE. So I started a multifamily focus, and from there scaled it up, and then branched out into retail and build a rent community, and then we have a 20 by 50 size storage facility for RV boats and businesses. So a little all over the place from a real estate standpoint, but that's sort of how my journey started.
Yeah, once you get into multifamily, and then you compare that business model to every other business model out there, you see how scalable it is. The operational friction that multifamily has compared to, let's just say, hotels, it is just second to none. I mean, you've got there's so many different ways that you can fail on other businesses that just don't exist in multifamily. Yeah. And that's from firsthand knowledge. So it's night and day. Tell us about your first acquisition as CREI and how that came about.
Yeah. So we, as many people did broker relationships, but I was also heavily focusing on finding off market direct to seller opportunities. So we were building up our list of true owners. And, that's a whole process of finding the true owners because a lot of them are behind entities. And so
Yeah.
unless you're doing all the grunt work to figure out who the actual person who signed on the documents who makes decisions. So we were going through that whole process, taking lots of time to doing it. And then I did a text blast to probably 500 different properties. Several reached back out, but one in particular was, interested in at least having the conversation. There were several that wanted to have a conversation, but this person, it took, I don't know, 18 months by the time he was ready to sell, but we stayed in touch. So it was an off market transaction and, deep value add in Houston. But that was our first deal.
What does deep value add mean for the listeners?
Well, a deep value add is a property that needs an incredible amount of work. So he owned it since 2007. Yeah, 2007. This was 2022. So he had owned it a really long time. And, the property was, in disrepair, didn't have a whole lot of money putting into the property. So a lot of a lot of roofs were leaking.
Was this a new property, or did he own it since? Like, what was the vintage?
Yeah, it was 1972 property.
Okay,
An older
got it.
property. Yeah, it didn't have a chiller system or anything. Had all individual HVACs, which was good. But when we bought it, great location, the Galleria submarket of Houston, 101 units, but needed an incredible amount of work, not only on the interiors, exteriors, but also just the tenant base and the reputation of the property. So it's a property that we had to go in and do pretty much a major renovation on every aspect of the property. And then not only that, we had to change the perception of the property in the market. And then we also had to change the tenant base. So that's what I consider a deep value add. I'm adding another deep to it because it was a lot of work. As time goes on, I haven't been as excited doing deep value adds or deep value adds, more doing more value add where you're going in and, it's already, 90% or so occupied. You're just, it's a big ship and you're just moving it slowly while getting cash flow day one and, seeing, not major shock waves that go through a property when you're having to go through a lot of that.
You might make less, or it seems like you're making less, but are you making less when you put in the time constraints in there and the amount of attention that it takes?
Yes, it was incredible amount of attention. That property was also bought peak of 2022. So like a lot of real estate investors, it just was like the perfect storm. We modified the loan and, continuing executing the business plan and such. So we're one of the very fortunate ones, even though, buying in 2022, where, a lot of those properties have gone back to the lender just across the country, or, there's been major capital calls to keep it alive. That was one of our properties that that we really fought through and, modified the loan. So I'm super happy and proud of what we've done for that property, but it also a lot of lessons learned. So as we've gone into other investments, looking for day one cash flow, looking for the upside, but also looking at like our real estate development piece where, there's not immediate cash flow because we're developing from raw land to, the actual development, but just being being much more risk averse on making sure we have enough reserves, conservative on the lease up, et
Keep the
cetera.
lights on. Are you developing before entitlements or after entitlements?
So both. We had our RV boat storage, which is all fully enclosed. It's not your traditional like carport. It's all 20 by 50 in size, 60-foot drive lanes, and a lot of businesses and boats, RVs, personal. Just these are massive 1,000 square foot units. So we developed that when it was already zoned, and then we got other land here in Bryan, Texas, that was zoned to retail, and we rezoned it to a planned development multifamily. And so there's 12 acres total. There were 3 land purchases to get us to the full 12 acres. 6 of that is going to be a multifamily plan
Nice.
development, and then the other 6 was retail.
You got some land plottage in there and
Mhm.
accumulating that's smart. And now you've got really it's a planned PUD.
Yes. Yeah.
That's
And that
good.
took several months to get through that process, and relationships, sitting on couches in people's homes,
Yeah.
explaining what we're doing. That is not easy. It's much more easy to, go within what's already zoned for the area. But
Yeah, but at the same time, the deals are made with doing exactly what you did. Like what other people can't and won't do is exactly where the good deals are made.
yes, well,
That's
there's definitely a risk component, right? Because
yeah,
we are doing all the risk up front before we even go to investors from an equity standpoint.
yeah. But you're putting
Um,
it on the table too. That shows alignment.
Absolutely.
Yeah, I like the way you operate. That's smart. That's good. Tell us about your multifamily holdings.
Yeah, so we have a little less than 400 units in Houston. So we have uh, 128 unit that we purchased in August of 2024. That deal was a loan assumption, a 3.82% fixed rate debt. So a lot of people in the real estate markets really recently, a lot of them have just sit on the sidelines because there's, in their opinion, no deals to be made. We've been finding deals,
Yeah.
and yes, the rates are higher, but we can do a loan assumption at 3.82% fixed rate. Again, it cash flows day one. We've already done a distribution, about to do another one here in March 2025, and so that's really our business plan moving forward. Prior to that, we bought a 44 unit multifamily in Galleria submarket of Houston. That was seller financing, 6% fixed rate. Again, just being creative and finding opportunities to close cash flowing deals. And then we bought another 105 units, and then the 101 units in 2022. So between 2022, 2023, and 2024, we've added about 400 units of multifamily. The thing that, Josh, that's I think unique to CREI Partners is I'm not, as the owner and founder of CREI Partners, I'm not looking to, have a property acquisition every 2 to 3 months. For me, our plan, because we're so deep involved with asset management, and we're doing, say, our own deals. We're not raising capital for other deals where we are a little more passive, because that main deal sponsor is running mostly of the day to day.
Right.
Like, we are the lead sponsor. We're running
Yeah.
through it. We're the main GP. And so, when we buy, like I say, that property, 128 units in August, I mean, it took about 4 months for us to get it to where we are happy, where in my opinion, it's stabilized. And now we're out looking for other deals,
Yeah.
right? And
Exactly.
so,
Take it off in
um,
bites, little
yeah.
bites. Yeah.
And in 2023, we bought that 44 unit. I mean, that is a small property compared to, say, 128, or, maybe what other people are doing. But that was a hard market to buy, with the financing markets. We were able to be creative by finding a seller financing deal, which is extremely difficult. And, that cash flows. So Q4 2024, we distributed a little over $100,000 in passive income between all of our properties. And this includes retail, our storage facilities, et cetera. But, that's, to me, why we do this, right? And we're going to continue growing, but we're going to do it in a way where it's systematic, and not just, trying to accelerate the unit count, just
Yeah.
make us look bigger than
You can have
we are.
2,000 units. That's 2,000 problems. And if you can't
100%.
manage the problems effectively, then you've got problems. And those smaller scattered sites, I mean, those are base hits. So we'll pick up base hits all day long. Those are little businesses you're picking up, and those
Yep.
accumulate to big things over time.
And
So
they do, especially if you get economies of scale. Like that
yeah,
44 unit was near my 101 unit. So there was some property management sharing there. So between the maintenance and the manager, we were able to, save expenses at both properties. And so I like how you put it, the base hits, because especially if you can get multiple base hits in an area and you can start creating scale, then, the economies of scale from reducing expenses and just being more efficient and running an asset definitely is helpful.
Are you all managing your own property management or using third party?
Yeah, we use third-party management for our multifamily. On our storage here in Bryan College Station, we self-manage, and then our partner in Huntsville, Alabama, he manages those properties, the retail and the storage facility there. My thought on unless you have like major scale in that market that you're buying, you know, self-managing is a risk based on like my size portfolio, because like if one person gets sick or they're on vacation, like who's going to be managing the asset, who's going to be taking care of the maintenance. Whereas like if you're with a property management company and say your property manager's sick, or your maintenance can't come in that week for whatever reason, maybe they're on vacation, maybe that's not a bad thing, they're just on vacation, having scale with other managers and other properties nearby I think are huge. uh, Also dealing with not only the personnel but all the resident laws and things that they have to work through. I like to keep it arm length distance. I also think it's good from a financial standpoint, keeps things clear or clean. And so anyway, there's multiple reasons why I prefer the third party management. But with that said, we are actively involved with asset management. So we are, from a helicopter view every week, working with our property management teams on making sure that they are, driving the business plan towards our annual budgets, also trying to motivate them, trying to, make sure morale, et cetera, is high. We have a full-time asset manager, senior portfolio manager on our team, and that's his full job, is to monitor and maintain the KPIs and the property operations that our property management is responsible for.
Yeah. Are your properties, are they close to proximity, or are they scattered in multiple states?
So we primarily focus in the Texas Triangle.
Okay.
A big bulk of our properties are in Houston because that's where I have found value. When I was looking in San Antonio, Austin for a few years, it was incredible. I would do an offer, and then it would be $1 million. Someone would win that bid, paying over $1 million. Well, they're upside down now. There's no way that they're surviving. And so, I had a lot of brokers, Josh, be like, "Hey, this property, is going to be your main regret." Looking back, I'm like, man, I turned down so many properties that we could have bought, but I didn't because we were staying, conservative and true to our.
I enjoy being paranoid. It's kept me very safe through the years, and buying a deal instead of buying it on pro forma. You've got enough units to really bring management in house. I think it's getting over the things, toilets, termites, and phone calls. But once you build that team out, I mean, then you'll introduce nitrous to your operation.
Yeah, I guess I could hire like a director of property management and then have them hire the on-site. I'm not going to say that's not ever going to be the case down the road, but I will say we are very fortunate with a really good property management firm that's boutique enough where they think like an owner. They align themselves really nicely to us. I'll do a shout out to MLDC Property Management. One of the things that separates them, in my view, is knowing who the regional manager is and how many properties he or she oversees. I've had management companies where the regional oversees over 20 properties, and when they do that, it's just you don't get much time from them, right? But the group that we have that are managing our assets, he oversees a total of 7, and 4 of them are my properties. So we get great engagement and service on that standpoint. So hopefully that will continue.
It's definitely a pickles and cheese business, meaning like all those everything's a paper cut. Everything, any expense is a paper cut, and you can procure deals with manufacturers, distributors on different pricing, and we're working with the HD Supply right now, possibly moving a lot of our purchasing over to them. And economies of scale, the more units you have, the better your pricing is. And if we can save margin on a property and pushes expenses down, more value the property becomes, and
Yeah.
everyone's happy. So but you have to, you're right, you have to have enough units for it to make sense, for it to personnel and everything else take on all the other liabilities that goes along with it. So it's how about renovations? You're using your third party to manage the renovations, or are you all plugging those people in?
Yeah, we use our property management team. They have an in-house renovations group,
Okay.
but we are continual. I mean, that you can buy a property and third party it and sort of be in the clouds of not knowing what's going on. But I
Yeah.
mean, we're so in the weeds of approving the units, you know, tactfully and respectfully questioning why they want to do certain things in units, because again, you don't want to come across, you want to be a team player and build the
Exactly.
team. And the way we see things from an ownership side, sometimes the property management doesn't see, because they want to have the best unit available for showing. And I get it, but at some point it's like, there's a balance between spend and what we're able to achieve in rental income, and what the actual demographic, what the people actually are caring about when they
Yeah.
lease up a unit. And so those are discussions we have every week with our property management team. But we go in, we have a renovations board that the management team provides, and it goes to every unit, provides before pictures, after once it's complete, but then prices, everything between, paint and resurfacing, flooring, appliances. And so we can go in and see the bids and definitely question or approve. And so that's been good, because initially there's a lot of more upfront type of discussion, especially when you buy a property, because you got to get everybody aligned to the vision of what ownership is. But once that alignment occurs, those approval processes go a lot faster.
Yeah.
And then the last one I'll say is the lender draws, because a lot of times the lenders hold funds, or maybe there's a replacement reserves with the lender. The management company, since they're running everything from A to Z, they already have the pictures, they already have the pricing. They're able to help streamline that draw process.
Yeah. Yeah. No, having everyone just march to the same tune, that helps. That's key for
Yeah.
sure. Very cool. So you got a mixture of developments going on. What's been the one that you'd like to take off into the sunset so far, that you've seen that just works?
Well, what I'd like to do, so I'm on my second RV boat, that business storage. I love it because the expense ratio is like 32%, compared to like multifamily in Texas, which can get you like 55%,
Yeah.
heavily because of taxes and insurance. So I like the low cost of the expenses on these type of facilities. I also like that there's no emotions or no eviction court, or, it's like, hey, you pay your rent, or you get locked out of your unit. And people tend to be more motivated to get their expensive stuff out of their unit by the 10th of the month, which is when I change the lock. And so it makes it very easy to manage and operate. So I really like that plan, and we're looking at scaling that at a much bigger scale. Um, and if anyone wants to see what it looks like, it's 20 by 50 storage.com, and you can sort of
Nice.
see the size and the look of these units.
That's
Um,
huge.
yeah, so they're all 20 by 50. We're not competing with mini storage. We have our own little niche, and not everybody's going to need that big of storage, but we get between we've just got between the HVAC companies, mechanical, electrical, plumbing, disaster recovery, generators. We've got interior staging for like homes that are being staged for sale. They keep their furniture in those units. I've got a toy distribution group that takes those units. They don't really need an office. They just need large warehouse space. Aside from that, I'm still very bullish, and I still love multifamily. There's been a lot of people, especially over the last few years, that have gone to car washes or gone to ATMs, or gone to the next shiny thing. And we haven't done that. We've been really focused and really doubling down on multifamily, because we still believe in the reasons why multifamily is a great asset, that everyone needs a place to live, and being able to provide a community, you know, to the residents that everyone can be proud of, is something really important to me, while also taking care of our investors. The
Yeah.
tax depreciation on multifamily is a lot higher than, say, storage. And the amount of buyers in multifamily are a lot higher than storage. So there's a lot of value creation that can occur in multifamily that I still love and will continue doing. I will also say this, Josh, like on our development side, I mean, real estate is already a risk. Just by doing real estate, it's a risk. We do not or currently do any developments outside Bryan College Station. So anything that requires shovel on the ground, building, developments, we're staying in our backyard.
Yeah.
I don't want to be 2 to 3 hours away from a development. I want that to be in my backyard. So that's what we're doing now.
That's
Buying
smart.
existing properties, we will focus continuously on the Texas Triangle. If one of our partners, say in Huntsville, Alabama, I love that market. But if there's an opportunity there, we'll look at it. But primary is Texas Triangle. That's Dallas, Austin, San Antonio, Houston, and then developing right here in Bryan College Station.
That website, the 20 by 50, is that spelled out 20 by 50 or is it
20x50storage.com?
20x50 storage.com. That's why I wanted to look that up real quick.
Yeah, it's pretty unique. And I got into it on our first property in Huntsville, Alabama. It stays 100% leased. Cash flows really well. It's a unique asset type that I'm becoming very bullish in.
Yeah. Yeah. No, multifamily, anything, apart hotels are definitely becoming a thing. Fully furnished, come and go. People are becoming more transient. They're wanting to just plug in and plug out. So it's anything residential living wise. I feel like it's going to be a thing. It's going to be a norm. It's providing those amenities to be able to just come and go.
Yeah.
So cool. Awesome. If somebody wants to reach out, get a hold of you, possibly invest alongside of you, how can they get a hold of you?
Yeah, I've been a big opponent of education. We love our investors who are educated on passive investments. So on our website, we have a lot of valuable education resources. Go to CREIPartners.com. You'll see an education tab there. We have a passive investors coaching program that's free. It's about 8 hours of just content about investing in real estate from a passive investor standpoint. We've got ebooks, we've got podcasts. So go to CREIPartners.com and hover over the education aspect. And we also host a monthly virtual meetup. And so if anybody's interested in doing a virtual meetup, they could reach out to me directly at wayne@CREIPartners.com. But again, just want to add value through education. And then, if the opportunities arise, would love for partnerships. But yeah, that's our way of giving back.
Yep, that's getting involved and getting educated and being able to talk the language. Very cool. Yeah. Awesome, Wayne. Definitely appreciate you coming on the show today. Look forward to following you. We'll talk soon. Thank you.
Good. Thanks, Josh. Appreciate you.
Thanks.